Hello, everyone. Welcome to another TMLS event, and this time TMLS Micro Summit in Finance. I'm Beta, your host for this talk. And I just want to mention that if you have a second, it would be great if you please fill out your profile. And also, you can use our networking session for networking with other professionals like yourself. Without further ado, I will introduce Ayeh. Ayeh Bandeh-Ahmadi has over 2 decades experience advising policy development at the departments of Treasury, Defense, State, and Health and Human Services, and at the White House. Most recently, she served on a 10% team responsible for managing U.S. Treasury's $20 trillion of marketable debt throughout the COVID-19 outbreak and deployment of the CARES Act. Prior to that, she represented Treasury as an expert on financial applications of artificial intelligence and machine learning to the International Financial Stability Board in Switzerland, and briefly served as program manager for OFR's grant programs and the study of financial computation. Before coming to Treasury, she studied backer behavior and what makes projects successful at Kickstarter. Her work in designing methods to map out technology landscapes of startups and their investors at Quid was featured in Business Week, the Harvard Business Review, and the Telegraph. And I just want to quickly mention that you can ask your questions in the chat section, and I will ask Ayeh your questions at the end of the talk. So without further ado, thanks to you, Ayeh, you can start. Thank you.
Thank you for having me. So I am going to start by just a disclaimer that the views in this presentation are my own and don't represent any government institution. I left Treasury in November after 7.5 years in several different capacities, and now I'm working for my own consulting organization. So let's see. I'm going to talk about 3 areas where I see opportunities at the intersection of machine learning and finance. First, I'm going to try to convince you that aside from using machine learning, we ought to be thinking about using whatever tools and data we can to understand how much machine learning is penetrating the financial market and what roles and impacts it's having. Second, I'm going to talk about how we can actually use machine learning to measure and study shifts in the financial system. And finally, I'll talk about strategies for using responsible machine learning tools that are robust to potential regime and regulatory shifts. I listed multiple examples for each of these areas on the slide, but in the interest of time, I'm going to focus on one example each. And I'm happy to kind of answer more questions about these afterwards, or I'll share my contact information so that you can get in touch if you want to reach out. So let's start with an example of why it's important to understand the extent of machine learning adoption. We'll look at some evidence on what happened to machine learning-based trading in the aftermath of the COVID-19 outbreak using supervisory data. Here we have average daily trading volumes in US Treasuries. And you can see how in February and March of 2020, there was over $1.3 trillion a day. Here it's showing weekly volumes, so it's a little bit less than that. And this was happening as the outbreak grew and the stay-at-home order happened. So these were kind of historic volumes. There was a flight to liquidity, basically. So everyone and their asset manager was trying to liquidate whatever assets they had to maximize kind of cash on hand. Maybe not everyone, but almost everyone. And when everyone's trying to sell, it becomes difficult to sell things. So naturally, the US Treasury market, which is the deepest and most liquid, historically was perceived as the safest asset that was the easiest to sell. So this resulted in these historic volumes and flows that were much larger and faster than the existing infrastructure had had to handle before. And when I say infrastructure, what I mean is dealers and interdealer broker platforms where dealers and other market participants trade. So for some more context, because I'm going to spend some time talking about PTFs. This is an acronym that's used interchangeably to describe a principal or proprietary or platform trading firm. The acronym was coined by firms that tend to invest their own principal rather than their clients'. And then it was adopted by regulators in after 2014 to describe investors which have their own principal who tended to use automated and high-speed trading. And since low latency typically means trading at timescales where humans aren't involved, there's often an element of machine learning involved here. So to be clear, this is a classification of firms based on their business model. And in the data I'm going to show you, FINRA, the financial industry regulator in the US, classifies firms as PTFs or dealers, but no one's looking over the shoulder of any companies or looking over like the code to check if it meets some definition of machine learning or high frequency trading. But we can kind of use this to get a sense of what was going on with these kinds of market participants. So with supervisory counterparty data, we can identify which firms fit this PTF definition based on FINRA's classification and look at how they behave in response to all kinds of news or market shifts. So you can see that PTF share of volume increased initially in late February, while in that last chart, we saw volumes were reaching historic levels. And then come early to mid-March, while volumes were still quite high, PTFs pulled back their share of trading pretty precipitously. So you can ask why this was happening. Some of the explanations are that cash futures basis trade correlations broke down, or that volatility was too high, or that certain participants widened their bid-ask spreads. Some will say that was opportunistic, others will say that's to compensate for meeting additional risk that existed due to high volatility. You can see that the PTF share of volume is typically well above 50% in the 10-year security. These are on the run, so that means the current, most recent issue of the security, and fell to under 45% of volume. And the dip was felt across tenors, but most significantly in kind of the longer run securities. As this was happening, the dip in PTF activity coincides with this sharp uptick in implied volatility. It's immediately followed by a sharp drop in depth, so a deterioration of liquidity on BrokerTech, which is the largest interdealer broker where dealers and PTFs can trade. And I'll show you some information later that data estimating BrokerTech is about 2/3 of that market for on the PTF, immediately followed by a sharp rise in bid-ask spreads as market participants asked for more reimbursement for each trade. So basically you can see that as PTFs pulled back, and that's, again, where we think there's going to be a lot of machine learning based trading, where that's going to primarily live, liquidity conditions deteriorated. And meanwhile, dealers, which had generally seen their role in these interdealer platforms lessen over the past 10 years as markets electronified and kind of lent themselves more to algorithmic high-frequency trades, dealers picked up the market share that PTFs left behind, but albeit at these higher bid-ask spreads. So the cost of trading to end customers was higher. We'll revisit this data shortly from a non-supervisory perspective. Like I said, this comes from some things Treasury's published publicly from a supervisory data set. But we'll come back to it from a non-supervisory perspective to consider whether any of this, or to what extent this could have been kind of anticipated. I think it was clearly beyond any financial modeler's purview to be able to predict that COVID would hit and to ask exactly when it was going to hit. But we can think about if there's any market shifts detectable as PTFs took a larger role in the market that might provide hints about what kind of impact a general shock to the market might have. And I'll talk later about how machine learning tools can be used to address this kind of thing. So I already talked about this. So the next category I want to talk about is using machine learning to study shifts in the financial system. I'm not going to talk about the natural language processing applications here, even though that's probably one of my favorite things to go into, just in the interest of time. But we'll focus instead on how machine learning tools can add more insight to the kind of COVID-19 analysis that I just showed you before. So we'll look at how machine learning can help measure shifting determinants of liquidity, how it can help measure shifts in algorithmic trading, and identify clusters of entities with similar trading strategies without relying on a FINRA or other external classifiers. So not surprisingly, much of the work that I did at Treasury or that happens in government agencies doesn't go through the clearance process for external release. So I'm going to show you an example of some work from Munir Salem, Josh Younger, and John Zhao at JP Morgan that tackles these questions. The other advantage of doing that is that JP Morgan doesn't have access to supervisory data sets. So they've been quite clever, like perhaps some of you here are doing today, in recreating some of the features of a counterparty data set from a commercial trade data set, broker tech, that doesn't actually identify counterparties. So once again, we're looking at the secondary market for trading US Treasury, fixed income securities. After the pie chart, everything's going to be focused on the 10-year on the run security. The pie chart, as I promised, breaks down where trading of on the run Treasury securities happens. Like I said, on the run means the most recent vintage of a security that's issued, and roughly 2/3 of the market, based on this data from Trading Places, was on BrokerTech's interdealer broker platform, where PTFs and market makers and dealers and all kinds of market participants trade. So now on the right, you can see that every time someone trades a Treasury security or a block of securities, the price can either move down on the left-hand side, or it can move up, or it can stay the same where the zero is. And this graph just shows a histogram of how much price impact moved up or down for every $100 million of trade flow in the 10-year security on BrokerTech's platform. And more recent years, going up to 2018, are kind of shown in the darker color. So you can see how this has sort of shifted over the 10 years prior to 2018. So price impact, which is this measure of price moving up or down, is a key measure of liquidity. And often you want to be able to estimate it as a trader because you want to know when to trade to minimize how much the market moves against you. And as a supervisor, you're likely to care about minimizing price impact because you want to ensure a liquid market. And in either of these capacities, you really want to identify the factors that drive illiquidity so that you can address them. So this set of graphs here shows some factors that predict price impact or predict this type of liquidity. So remember, a higher price impact, the more price moves for a specific size of trades, that means the market is less liquid. On the left, the first chart, you can see that price impact on the left side y-axis falls as market depth increases, so as the order book depth falls. In the middle graph, price impact increases when flow is increasingly skewed towards buy or sell side. But then for purely one-sided trade flow, it actually falls or becomes more liquid. On the final graph on the right-hand side, you can see that price impact is low for really fast flows. In other words, price impact is low and liquidity is high when high-frequency trading is at its peak. And price impact rises as trading slows. So it appears that high-frequency trading is tied to better liquidity conditions. And here you can start with the graph on the left-hand side. Price impact, this is showing price impact from 2008 to 2018 in the black line. And then there's machine learning estimation of price impact based on the 4 factors the authors found were the most predictive. You can see that baseline liquidity is measured by price impact over this period. It's kind of improved. It's dropped in recent years. And the machine learning models in blue and gray do a good job of estimating price impact, although from 2017 onwards, you can see that blue and gray lines depart from the black line, pointing to a market shift. something's going on to make the model, these machine learning models, be less predictive, and that means there's something, potentially to understand or dig into. The middle graph here, the bar chart, shows the relative feature importance of the factors in the random forest model. The market depth, buy-sell imbalance, so how much trades were geared towards more buy side or aggressive side, or how balanced those two side of aggressors were. The bucket lifespan, which tells us the speed of $100 million of flow, and the hidden depth of the order book. So market depth and the buy-sell imbalance are not surprisingly the most important drivers of price impact liquidity on average, but trade speed, so in other words, the extent of kind of what we know tend to be these machine learning based high frequency trading algorithms, as represented by the bucket lifespan category, are also important, as is hidden depth. The third graph, though, is really where it's at here. So this is showing us how the relative importance of these features actually shift over time. And we can see there's really some crossing of these lines, so the relative ordering of their importance shifts. And that's a really key way in which machine learning models can help us measure and understand shifts in the market and what's driving them. We can see here that flow speed is really moving up in importance of how much liquidity it explains. So that's something that's going on with, we think, these PTFs or high frequency traders. So now in the rest of these graphs, the authors used anonymous trade data to build out something you'd normally need counterparty data for. They don't identify specific firms that are trading, but they do identify categories of trade activity by the speed at which they're occurring. And that categorization can arguably do as good or a better job of identifying meaningful trends and bodies of trades, because you might actually have, some dealers that are participating in higher frequency algorithmic machine learning type trading, and you might also have some platform trading firms that are doing some trades that are maybe, not as much based on that kind of thing. So how did they do this? How did they kind of identify what kind of activity each trade is associated with? Well, let's start with the graph on the left. They notice there's a speed signature to how fast trades occur. The x-axis here shows speed in seconds on a log axis. So in the left graph, the x value of 0 corresponds to 1 second, -3 to 1 millisecond, and so on. The blue histogram bars show that there's a large, they show the trading volume that happened at each of these speeds. And on the y-axis, it's showing the count of $100 million flow buckets at each speed. So you can see there's kind of this bimodal distribution showing a large mass of trades that are happening at the sub-millisecond speed, and another small mass around hundredths of seconds, and a third mass around the 1 second speed per $100 million of flow. The black line shows how the average price impact of a trade increases as speed slows, moving to the right. So high frequency trading is price impact in the market. So now moving to the graph on the right, this shows the same thing across 2008 to 2018. But instead of counting the number of $100 million buckets of trade flow, the histogram's counting individual trades based on the time that elapsed since the last trade. You can see that the distribution shifts to the left, meaning it's getting faster as you move down this graph to more recent years. And there's also a big shift that happens after 2014 when the data resolution goes from milliseconds to microseconds. You can also see the vertical-ish black line that tracks the middle mass of trades that happens at roughly 1/100th of a second after the last trade. That's the line the authors use to define fast or high frequency trades in some of the subsequent analysis. So once you've identified these different groups of trades, you can look at what drives those fast trades. What time of day or market conditions do you see more fast trading? It turns out that fast trades subside when there's auctions or FOMC meetings or other potentially market moving events. That's a hint that if some sort of shock were to hit the market, it might have a similar kind of, the market might, respond by drying up liquidity. In the middle graph in blue, the authors looked at the share of the market that's transacting at high frequency trading speeds. So they defined that as the share of those of $5 million flows that happen in less than a hundredth of a second. And in black, they have implied volatility, but the volatility axis here is on the right and it's inverted. So what's happening here is that the share of the market transacting at high frequency trading speeds that's associated with things like machine learning algorithms, that's inversely correlated with volatility. So on the right-hand graph, there's the right-hand graph is showing on the y-axis the correlation coefficient between market depth and volatility. And they're looking at two different kinds of depth. So in black is just kind of vanilla market depth. And then in blue, they broke out from the order book, the high frequency trading provisioned part of depth. So it's depth that seems to be coming from kind of these really fast algorithmic traders. The correlations tend to be negative for depths of all kinds with volatility, but then in 2017, you see this shift happen where even though market depth remains negatively correlated, after 2017, the high frequency trading fraction of depth is becoming positively correlated with volatility. So that's really pointing to some sort of shift that happened in the market. And perhaps we can think about why that might be. You could say that maybe that's because high frequency traders can rely on cash futures basis correlations that are consistent in markets to make markets or to other factors. But in any case, this pointed to this additional liquidity we're seeing at that point in the market that could potentially evaporate if whatever these high frequency trading firms are relying on to provide that extra liquidity were to go away. And arguably that's, maybe what we saw happen with COVID and even prior to that with the repo spikes in September of 2019. It's not that all the liquidity went away, but there was a portion of liquidity that left. And ultimately you ended up with a period in March and April of 2020 when dealers, even though they were balance sheet constrained and ending up intermediating more than half the volume in some of these markets, where just before fast high frequency trading firms did most of the intermediation. And this shift was because you had these algorithmic machine learning based traders that had seen the correlations break down and said, we need to step back or step away until we can build enough of a training set that we can rely on our models again. So you can imagine its useful intelligence, not just as a supervisor, but also as a trader. The opportunity here is to use machine learning for more forward-looking stance on what's happening in the market and what might be coming down the pipeline the next time there's something that breaks down a particular correlation. So the last opportunity I'm going to talk about here is building machine learning applications that are robust to potential regime shifts and regulatory shifts. So basically building more responsible algorithms. And I'm going to skip the sandboxes and simulations for trading algorithms. We'll skip to talking about how and why to build machine learning algorithms that are long-term incentive compatible, and also what that means. So there's a broad range of business applications that currently employ or could potentially employ or benefit from machine learning tools. So think about things like lending to businesses or individuals. You could use machine learning to set approval decisions or to set the rate or price that's charged. In insurance, you could cost what an individual or entity's risk is using machine learning to combine a bunch of different factors. But it's not just industry. You also have auditing decisions, which could be industry or in other sectors, where you have to think about which entities to prioritize for audits. So this is where we're using machine learning to support making decisions. So on the plus side, machine learning tools have made it possible to incorporate alternative data sets, things like, are you paying your cell phone bills on time, or online behaviors, or text that you might write, into underwriting decisions. And that's expanded the base of firms and individuals that are served, and that's a really good thing. But on the other hand, research and anecdotal examples suggest that machine learning algorithms often identify predictors of loan default that are poorly understood or even problematic. So things like mentions of religious terms by loan applicants, the tone of loan applications, or the time of day at which a loan application is submitted. So basically what each of these things have in common, is that they're features of applications where it's not immediately clear why they're statistically significant. And some of these might even count as discriminating against protected classes. So here's an example of a paper by Odette Netzer and his colleagues where they identify terms that are predictive of default and in Prosper.com loan applications. And that's where it turns out that, mentions of God are some of the most, or saying God bless you, are some of the strongest predictors in this sample of loans that are going to go on to default. It's a really interesting paper, so I recommend looking it up, but I'm just going to kind of go over it really quickly here so we can move on because we're running out of time. I guess just the last thing to say is that an opportunistic lender might say, let's use those words, especially if they're not violating protected classes, like mentions of payday loans, which also show up in a similar way in that data set. But a more wise lender might consider what's actually going on behind the scenes and how a decision to employ some of these features might play out. So this is where I want to talk about incentive compatibility. In economics, we say that a policy is incentive compatible if when individuals are trying to game the policy to serve their own ends as much as possible, they end up doing exactly what's also best for the entity that set the policy. So policymaker here doesn't necessarily mean a government policymaker. It just means whoever the decision maker is that's setting the algorithm. So it can be a lender or an underwriter or an auditing team. A lot of times this concept's used to describe application systems that encourage short-term truth-telling behavior on the part of applicants, but you can also take a much longer-term view of this and consider how applicants are likely to act if they can figure out that mentioning payday loans or religious terms on their applications is going to get them rejected, or that submitting applications after midnight is going to make them more likely to get rejected. And this last piece about submitting applications after midnight is an example of something I understand is actually currently used in some places to evaluate loan applications. So the thing to consider is that if an algorithm can be played, it's probably not worth its salt, especially if it can be played against the interest of the entity using the algorithm. The other point here is that there's an opportunity to consider what kind of lending policies or machine learning decision support models are robust to gaming by not just capturing sample bias or spurious correlation that might go away with time, but and not just relying on applicants or users to stay ignorant about the decision model. So doing that, taking this opportunity, helps to ensure that the applicant base has incentives to make substantial changes for the better. So perhaps towards being more creditworthy rather than just performing some inaccurate, short-lived picture of what creditworthiness is. So how do we do that? I know I'm talking to a pretty savvy audience today, so I'm sure some of these are things that some of you are aware of, but we can first and foremost start by looking at incentives to ensure that you're doing this well if you're in an organization that's really focused on a short-term business model at the expense of looking at the long-term. In terms of data, there's looking at sparsity, where does it occur in the data set, interrogating sample bias, are realistic ranges, real-life ranges of variables and groupings of variables being represented in sample training data sets. Investing in gathering data in blind spots, or making sure that there's a plan in place to kind of deal with blind spots down the line and work around them in the meantime. And also building in automated monitors to track shifts in the real life variables over time, so you're ahead of the game if and when a training model has insufficient coverage. We can also look to making sure we really understand our models, and there's an opportunity here to make sure that we're looking at not just individual features, but how groups of features together, when they're interacted together, correlate with or kind of capture protected classes of information. So that's one way to kind of stay ahead of existing or potentially new regulatory shifts, and also keeping humans in the loop. So I think one of the last things I'm going to say is that, and this is the kicker for that maybe kind of comes from working in supervisory roles. Basically, when you build machine learning algorithms that are long-term incentive compatible, there's an opportunity to give feedback to applicants on what they can do to become more creditworthy or less audit prone. And you can do that because when you're building incentive compatible, long-term incentive compatible algorithms, providing that kind of feedback only helps your business and your mission. So there's also an opportunity to build aggregate metrics and statistics that explain the kinds of variables you're using and why they're compelling to educate potential applicants. And these kinds of metrics, when they're tracked and published over time, are the kind of thing that helps to develop standards and ultimately regulation. So the bonus here is that by making these choices, you'll be better poised to thrive despite regulatory risks, to build relationships with policymakers where they may even make use of your data and contribute to future standards. So I'll close by saying, hopefully I've convinced you that by engaging with these questions, bringing a supervisory or systemic lens to machine learning problems you tackle as an organization, that we can identify risks earlier, detect market shifts as they're happening, and build more sustainable algorithms and business models that are robust to changes in financial policy. And indeed, I think a trend that I've observed is that in as much as regulatory oversight continues to evolve and isn't going to go away, it's often the companies that are developing the algorithms or running the exchanges that are setting the conversation, the standards, and policies in the financial space. So I'm going to close with that and take any questions.
First of all, I want to thank you, Ayeh. It was a great talk. And we have a couple of questions. Based on your experience, what do you think? How successful are we currently at avoiding the impact of negative biases? And our audience asked that, can you speak to that current status of these efforts?
Do you mean negative biases maybe
yes,
in
machine learning algorithm?
So I think we're really in a kind of nascent stage of using machine learning algorithms. We've definitely gotten a lot better. I mean, there's best practices out there for things like transparency and explainability to drive doing a better job of these things. But anecdotally, and I mean, part of the issue is that there isn't, even one agency or one perspective from which you kind of get an overview of all the ways that these things are used. So anecdotally, I mean, I think I've just heard some stories a couple weeks ago about data scientists just kind of saying, okay, here's a correlation, let's throw that into the model. And that's definitely, from my perspective, not the wisest way to make policy, not just the federal agencies, but you want to kind of address these risks, even I think if you're working at a startup, because that's how you learn, that's how you ultimately build a business that is going to last.
Great, thank you. And I will ask related questions one after another. If you have another question, what is the state of ethical oversight over, machine learning application in finance? And in your perspective, what can be done to make these tools and insight accessible to all?
So I'll mention, I'll answer part of the question by saying that I think I've sat over the last several years in a number of meetings with policymakers, from financial policymakers, who I guess might be kind of from the government side responsible for oversight into these things, from not just the US, but many, many international and global agencies. And I've sat in meetings where agency representatives multiple times have asked financial firms, from fintech startups to large established banks that are working on these kinds of algorithms, ask them, what should we do, or how should we set policy around this kind of algorithm? How should we set oversight on this? and gotten the response from industry reps that, well, that's your job. You're the government, and you have to tell us what it is that we should do to have oversight. And part of the challenge is that I think as much as agencies are trying to kind of bring in more expertise and are starting to build some of these models, there's a lot of learning. I mean, first of all, the knowledge is really specific to each subject. So if you've built machine learning models, you know that while the tools could be similar, the training or tweaking of a model is going to be different for one subject matter to another. So I think there's really, so I think this is something where we're all learning regardless of what sector you're in. And there's an opportunity there to not just lobby for, the biggest short-term grab you can, because usually that doesn't work, but to seek out algorithms and policies that are likely to serve the interests of a stable financial sector in the long run. And personally, and this is just my view, I think that I think that a lot of that is ultimately going to come from the private sector. And it's not the thing that the private sector is like the most, top of mind to do. But I think that that's where so much of the knowledge and practice is, that I do think that's where I see in some cases that happening. And an example is, we'll see like central clearing parties in the financial sector will build a lot of their own algorithms to identify, well, what's the risk that in each individual entity that might trade on their exchange presents at any point in time, and use that oversight of the kinds of algorithms that those entities are using. So I think really we're going to start to see it where it starts to affect bottom lines.
Great, thank you. I'll go into some more detailed question, and then we can go back into the more general ones. One of our audience asked that to what extent is some form of causal inference important when applying machine learning and this kind of applications that you mentioned throughout your presentation?
Yeah, that's a really great point. So I think causal inference could be another point on that list of best practices. I think the kind of causal inference that's relevant, so causal inference is going to mean understanding which factor came after which other factor, and which factor actually drove the other factor. It's going to depend on what subject you're looking at. And I think a lot of times, even when it's not possible to do causal inference, you can use machine learning to bubble up insights that you later kind of build other models to actually test and make sure you understand before you codify those. So I think that's one approach where even if the machine learning isn't doing the causal inference, you can use it together with either causal inference or something else that convinces you that it's okay.
We have one other interesting question, which is usually a question that comes into most of the talks that we have, also people from research and academia and also industry, and that in your perspective and your view, what is the primary difference between the machine learning and finance use cases we see in research papers and in academia and the actual real world scenarios that we've talked so far?
I think that there is actually a lot of reading papers that from academics, and then some of the papers that I was talking about here are actually put out by industry practitioners. I think that there often tends to be silos in terms of different teams and what disciplines they recruit from. So I think economics brings certain expertise in terms of causal inference, but doesn't have the same deep history with machine learning. And you have subject matter experts in different areas, that kind of thing. But I don't see a hard line. Obviously, access to data is one of the challenges, and I think that that's an area where we really need to do a better job of cross-fertilization.
Thank you so much. And one last question is that in your perspective, how technically aware about machine learning are people who are in charge of some sort of and such oversight of various use cases you mentioned, um, how much they are expert in machine learning and these kind of algorithms?
So I've been continually impressed by how much I've seen, staff in government agencies learn about and really become experts in this area pretty quickly. But I think that there's still a real dearth of subject matter, like the intersection of machine learning and subject matter expertise, because the applications are changing and developing so quickly. So I think that that's the reason why I think that industry is going to play such a big role in helping to shape these conversations and determine where the goalposts are and that sort of thing. And either it'll happen by proactive, or sharing this kind of information publicly, or having reach outs or meeting with supervisors, or it'll happen because something bad happens or consumer groups speak out. And I think the former is definitely preferable.
Thank you so much. Again, I want to thank you for your talk. It was very interesting and informative, and also I want to thank our audience that joined us today. Thank you so much.
Thanks. It was a
Thank
pleasure
you,
to be here.
and have a good day.